We're back on Morning Movers with some breaking news. Shares of CoreWeave rallying after announcing a deal for over $14 billion with Meta Platforms. The company will supply computing power for Meta, with the CEO telling Bloomberg, quote, "They loved our infrastructure in earlier contracts and came back for more." That stock rallying more than 8% in the pre-market. Keep in mind, it's already up more than 200% this year since its public debut. Time now for Options Corner. Joining me now to take a look at Nike ahead of today's earnings that come after the closing bell. We've got Rick Ducat, lead market technician. All right, let's talk about this chart. Nike's been trying to stage this turnaround this year. The stock, though, still lackluster. What trends do you notice, Rick?
Right, exactly. If we look at our 5-year chart of Nike versus the broader market, really underperforming, down almost 47% during the past 5 years, while everything else has been enjoying some pretty decent gains. The S&P has almost doubled during that time, 91.5%. But it's funny, though, because if you look at it from a different way, year to date, Nike's doing the best out of these apparel companies here. On Holdings, Under Armour, Decker, Lulu, all doing terrible. It's a difficult environment for these apparel companies right now due to the kind of tariff uncertainty here. So it kind of all depends on your perspective here for this situation. But now if we were to look more closely at Nike, falling wedge type shape here is the prevailing recent price pattern here, with resistance at the 80 level that we tested twice, and also here at the 72 level. That was a notable low that then we had our breakdown point. To the downside further, 69, old low, old high, and then that's about where we stabilized during the previous session there, where we did dip below that 69 level but recovered. So if we were to look at our moving averages here, all of our moving averages that we follow here are kind of clustered together just above the current price activity. Now, that is not great, though, because price has crossed below all three of them almost in kind of one fell swoop here, just one rather rapid decline here. Now this gives us a resistance confluence between about 72 to 74 or so. And then, so that could be another notable upside area to watch. RSI starting to improve, though, breaking above that oversold area, that threshold of 30. Still a long road to go before we get back into bullish territory.
All right. Yes, indeed. Definitely a long road before we get back to that. Thank you, Rick. That's Rick Ducat, the Duke of Data himself. Now, take us through an example trade. We've got Tom White, senior options contributor and co-host of Fast Market. All right, Tom, what's the approach for an example trade here for Nike?
Well, implied volatility levels are elevated going into this report, as it typically is going into an earnings event, and you have additional risk, right? So I looked at this, the option market pricing in a one-day move of about $5.30, right? About 7.5% either way in the shares. Rick mentioned the oversold areas. The bar is really low in Nike. And remember, last quarter, Nike jumped 16% the day after earnings. So if you expect that to happen again, the bar is low on this stock, down about 8% this year. This strategy takes advantage of it while limiting your risk reward setup on this type of trade. Really good at this point. So that one-day move, about plus or minus $5.30. But a 17-day move out to the October 17th monthly options is about plus or minus $7. So I looked at it that way, where if you think this thing is going to pop because the bar is low on this one, and the expectations are too low for this company and they're going to surprise to the upside, this takes advantage of it. October 17th monthly options, 2.5 weeks to expiration on this. So even if you don't get that move initially post earnings, you've got some duration. Buy the 69 strike call, that's slightly in the money. That's going to react more like the stock. It's got the higher delta. And then against it, to offset some of the costs on the purchase of that bullish call, we're going to sell the 78 strike call. So a bullish $9 wide call vertical to the upside. You're going to pay roughly about a $270 debit if it stock opens up here around 69.5. That's going to be your risk, $270 per spread, but that can expand to $9. So you're paying less than 1/3 the width of this bullish call vertical. That's good on a risk reward basis. Takes your break even up to 71.70 to the upside. That's where you need it to go above. That's only 3% above where the stock's going to open up this morning. So well within that one standard deviation one-day move. But the risk reward setup is good on this one. You're giving yourself some duration, but you definitely need a move to the upside of about 3%. And you have that flexibility as far as trade management goes because you are buying this vertical and you got 2.5 weeks in the trade.
All right. Thank you for that one there, Tom.